And we're off. Welcome everybody to the Markets Policy Macrocast. This is the new era of the Macrocast, the new format. Thanks again to our friends at Penta, and prior to that, Hamilton Place Strategies for hosting the show for so many years, and the fantastic hosting duties of Tony Fratto and Brian DeAngelis and Elon Mui. And we're excited to be carrying the torch and kicking off with a long-term, repeat Macrocast stalwart. Brai Valerio-Esene from SW4 Insights. And let's dive right in. Brai, this week really featured the inflation data. It was sort of the third in the trio of big major inflation numbers, this one being the Fed's preferred metric, the core PCE price index. And drum roll, please. What did you see in the numbers, and how do you think it changes, if anything, if at all, the outlook that you have for the Fed?
Well, so I mean, I'm curious. Obviously, you guys will chime in, but on the one hand, given I guess the uptick, the surprise uptick we saw for the January CPI, I think folks were a bit more primed this time around for this number to be, a little towards the higher side, and I think it confirmed a lot of chatter you saw amongst the Fed officials preaching patience and making it very clear that they were nowhere near to even beginning the discussion about the discussion to, about when they're going to do that first rate hike. I think you saw Phil Jefferson, I think Lisa Cook also spoke last week. I think about a bunch of governors spoke last week, and they all had the same theme of like, where we want to see a bit more evidence, a bit more certainty around inflation numbers before we begin to even contemplate changing course on monetary policy. My one question and my one area of not confusion, maybe that's the right word, is that, as we know, a lot of companies in January raised their prices, right? It's that like beginning of the year, January price hike. And so I wonder how much of this, both in the CPI and the PCE, is a result of that versus more entrenched, stubborn inflation.
Yeah, just remembering, talking to the BLS people back in the day, January is hard for everything. So for the jobs number, it's really hard. We actually lose 1 million jobs, so they have to seasonally adjust it to make it look normal. And then the same with prices. Though, Brad, did you see the story about the BLS sending an email to their super data users saying that maybe there was something weird in the data in January, and then they kind of pulled it? This was a couple of days ago.
So I saw a headline, but I didn't chase it down. But do you have more info?
So the email said that there was something about the housing component in January, and there would be future communication, and then the press got it, and they kind of haven't said anything more. But so much of what the January price increase was heavily related to the housing market, and we know that the BLS data is very much lagging the real-time data. So I don't know what it is, but it seems like maybe they're trying to do something with the housing measurements that seem to be not fully reflecting the reality that we're seeing on the ground.
Well, I mean, as I think you guys have seen since we entered this quote unquote inflation crisis, there have been a lot of criticisms aimed at, I think, CPI in particular, and how it measures housing inflation. I think there's a lot of belief out there that it's lagging too much what's really happening on the ground, and it's not capturing quickly enough the changes in rent. And you hear a lot of times, both when Fed officials speak and other influential, what I call economic thought leaders speak, that they claim they're seeing rents going down, and it's not being captured in the CPI. So it could be that the BLS is attempting to play catch up here and maybe tweak how they're calculating this to more accurately reflect what's actually happening on the ground in rental data. But like you said, I guess until they release something, it's also
we don't know. And the scenario that worries me for the Fed, especially in terms of communications, is because we know the housing is going to come down because it's old data and it's rolling averages. But the February super core numbers were the highest we've had, kind of in a year. So the super core takes out everything. Not really. It takes out food and energy, but it also takes out that housing component. and those we're seeing kind of accelerating, and a lot of that has to do with goods no longer deflating. Goods are kind of either flat or starting to go up, and especially now in February, we're starting to see the reality of the Red Sea shipping constraints seep its way through into the supply chain, and it looks like it's seeping its way into the consumer prices.
I have a client who is a medical device manufacturer, and they export and import from all over the world. And we've been having conversations since the beginning of the year around the issue in the Red Sea, because some of their stuff was coming from Asia is routed through there, and they have already started sounding the alarm about delays that they're seeing. That stuff that should have taken a week to arrive is now taking 2 weeks. And his prediction is the president of the company that I'm speaking about. His prediction was by end of Q1, you'd see things really come to a head. And so, yeah, it would not surprise me if what was your comments about that uptick in goods prices is that starting to feed through. And, fingers crossed, we're not getting a situation as bad as what we saw in 2021 with the supply chain crunch. But yeah, it bears watching.
We have a super intern, Kutso, who's at the iPad program in Fordham, and she's from South Africa, and hopefully she can listen to it. She's going back this weekend, but she's been sending us pictures from her friends in Johannesburg of all the ships coming around the Cape of Good Hope, where they've never seen them before. And now it's one after the other, and they literally come as close to the coast as they can to make it as a short of a trip as possible.
Yeah, it gives you flashbacks to the all those like COVID era scenes of the tankers and shippers all like floating out in the bay. It was it sort of sends a shiver down your spine thinking about it. But taking a step back, Brai, when you look at the inflation, which camp are you in over the long term? Do you think that inflation, despite some sort of maybe Q1 hiccups with the supply chain, do you think that inflation is going to settle down back into the Fed's target range, or do you think, as some economists are positing, that this kind of last mile, so to speak, is going to be really challenging for them to close the gap on?
I think I'm definitely in the last mile camp, because I think you see certain items and items which I believe the Fed has no control over, meaning food, right? So food prices just have remained stubbornly elevated. I think Walmart who predicted they would come down, and that never happened. So things like that, where monetary policy can't really impact as much. You need more supply, right? And once you get that supply into the pipeline, the price is going to be elevated. They have the unforeseen events. You have the ongoing war between Russia and Ukraine. You have the Israel-Hamas war in the Middle East. There's too many things out there, again, that you can't account for, that, as we've learned from the past few years, can just derail everything. So I think that, this last mile is going to be a hard slog. Fingers crossed we get there, but I don't think it will be just like a smooth landing. No.
Yeah, and yesterday, where all the focus was on the inflation data, the other data was actually, I think, much more important. So with the personal income, wages are continuing to grow, especially at the kind of the lower blue collar jobs, which is a great thing, because that is catching up over kind of 20 years. But on spending was down 1%, way below expectations. And it always pulls back a little bit because everyone buys Christmas presents. But also initial and continuing jobless claims jumped higher. So we're kind of seeing that first. The tightening is that happened last year is starting to seep its way through into the overall economy and slowing it. But then, you have this possible inflation issue. So the Fed definitely, there's enough data on both sides to warrant holding, or there also is, seeing some cracks that, might justify a cut later in the year.
And you mentioned personal income. So it looked like, adjusted for inflation, there was no increase in income. It was flat, right? And so
the real prices, exactly.
Which one explains the slowing in consumption, because it's like,
exactly.
I've barely seen anything improve. I'm not going to go out and buy a bunch of stuff, and so that does concern me, because even if you see the inflation rate slowing, it doesn't necessarily mean people's personal financial situation is improving as a result. And so it might be, I worry sometimes if it's already too late. If they're able to bring the inflation rate back down to 2% annual rate, the damage to people's pocketbooks has already been done, and can they will be able to be able to rebuild or fix that damage or repair that damage.
Right, and especially the slowdown in the labor market has been in white collar jobs this time. That's where we're starting to see the wages soften, but also the big layoff announcements are coming from the tech sector and things like that, where the service sector and healthcare sector is still kind of playing catch up and hiring people. But obviously, someone who makes more money is able to spend more money, and that goes all into the total pot. And we're seeing a pretty the data yesterday in terms of spending, that was a pretty significant slowdown.
Yeah, and the first thing I'll say on this is that even if I put this before the Macrocast, because you have a little comedy hidden in me somewhere that comes out now and it's a rant. But even with a 2% inflation rate,
yeah,
it's on top of all the 9%, 10% we've had to this point.
That is such an important point. Yeah.
It's a cumulative price increase. It's not just we're down to the price rates of 2019. It's a whole nother ballgame we're in right now. And
the price of milk is still 15% higher, even though it's not going up as much anymore. It's still 15% higher than it was a couple of years ago. And I think that's where a lot of not even just political, but when you see the consumer surveys where the consumer just isn't all that optimistic, even though if you just looked at the data, you'd be like, everyone's got a job and inflation's coming down. What are you complaining about?
Yeah.
Well, that sort of plays into the view right now in the markets. If there's a slowdown coming, tell that to the stock market right now. Of course, it's skewed to some extent by the outsized gains in tech, which and Nvidia and that sort of thing, which are their own story. They're less leveraged to the overall sort of growth outlook for the U.S. And
we invented this new thing, AI, that is really taking a hold.
Right. But
it seeps into the economy. That's a whole new evolution. Yeah.
The more economically sensitive, like the mid cap, like Russell 2000, that sort of stuff, is underperforming, but still performing pretty strong. It certainly doesn't look like a recession is coming. Stocks are always the last to know, but you look at the bond market, and aside from that nagging inversion of the yield curve, the levels of there's really nothing in there that is that's flashing a warning signal. Do you think that there's a sort of false sense of security, Brai, about this soft landing, and that it sounds like from what you're saying you're a little more negative on the outlook for the economy? Do you think that a recession is a significant risk over the coming quarters?
I would not say significant. I'm not like a Larry Summers. If things are, I do think caution is necessary. I think there's a tendency, particularly within the markets, where you might have people who are fairly, I say young, young is a relative word, and they were not around for the pre-08 low interest rate, higher interest rate environment. They're used to low rates all the time, and so anytime they hear one bit of positive Fed data, one bit of positive Fed commentary, they just go and they rush in, purely because, again, similar to what happened with the 07 housing market crash, in terms of there's things bubbling underneath the surface that are not always apparent in the broad aggregate data. And so by the time it's too late, and everyone's all cashed in all their chips, I do think the consumer bears watching. I think the COVID savings have been run down or near to run down, for example, as another point for being careful. So I do think, given the state of the consumer and the lack of a financial buffer and the low savings that they have to call on should they need to. Oh, and credit card debt, right? We're seeing the New York Fed has this data we put out showing higher delinquencies of credit card debt, high delinquencies of auto loans. You know what I mean? If we're in a good place, those things should not be taken upwards, right? So I would not say we should be worried. I'm not pulling I'm not flashing red on the economy. I'd say I'm on orange, if that makes sense. I am flashing orange. Just proceed with caution is what I would say.
And given all your views on inflation, your views on growth, how does that translate into your expectation for Fed easing? So right now, we've seen the market be kind of manic depressive about the Fed, right? It was in October, the Fed was, yields were spiking up. The Fed was going to be incredibly hawkish. And then by the end of the year, it was 90% implied odds of rate cuts starting as early as the March meeting and that sort of stuff. Now we're kind of somewhere in between. The futures markets have backed up considerably based on the recent data and the communications from the Fed pushing back on those early and aggressive rate cut expectations. So now I think the base case is kind of around June, July, I guess. Where do you come down?
Frankly, I would be shocked if they cut rates in June or July. I would be shocked because I don't. I mean, a lot can happen in the data between now and then.
Right. Yeah.
I'm just
assuming we stay on the path we're going.
Right.
Yeah.
At this point in time, based on the commentary from those who are stressing patience, I don't see it. And then you factor in this little tiny thing called an election happening in November. Like my prediction, guys, I see a rate cut in December.
Yeah, that's when you think the first one is interesting.
I think December. Before then, I don't know how they see enough to make them confident that they can go in June or July. I'd be shocked. I think December makes the most sense. Like by December, we know the election's done with, so there's no accusation of cooking the books for Biden with that stuff. December gives you a full year, almost a full year's worth of data to analyze, and you can sort of like erase any seasonalities or noise or volatility. I think December. I just don't see anything coming before then.
It's going to be if the economies we just haven't seen in this post-global financial crisis era, we haven't really seen a meaningful slowdown in the U.S. economy that hasn't been met with significant Fed easing. Is that a correct statement? I mean, the sort of knee-jerk reaction is if growth is coming down, the Fed is going to be there to ride to the rescue of the economy. And this sounds like a very different formulation. If we do get that sort of sticky inflation dynamic through the coming quarters, and we get consumers tiring out progressively, just after after all the savings got burned down and the sort of body blows of high prices, and we do have that that whiff of stagflation coming through, and the Fed still denying markets the rate cuts that we know that they'll be braying for under that kind of conditions. That's a challenging time for risk assets, it seems.
Yeah, because in the past they never had to worry about the inflation mandate. It was always at or below 2%. So if growth slowed, why not cut, right?
Yeah, look back at 2019.
Yeah, exactly. That's a perfect example.
Yeah, the Fed was cutting rates because Trump started a trade war with China, and they said, well, what the heck, he's yelling at us, and we have justification for it. You go back and look at the economic data, and it certainly doesn't scream, need for aggressive rate cuts. But that's what they did, and they did it as a preemptory measure, a sort of prophylactic measure to insulate the economy from a trade fight that was an executive decision. So very, very interesting time. And so you alluded to politics. So I know we're coming toward the end of the show, but when you think of the Fed and their attempt to try to stay out of the political spotlight, it's going to be hard over the coming months, and perhaps the coming years. Former President Trump showed himself to not be shy about editorializing on the Fed. How do you think that the campaign and the campaign rhetoric and some of the platforms that the candidates will be putting out there, how do you think that the Fed will try to bob and weave from those?
Well, I think, oddly enough, normally I would say yes, the Fed should be worried about being like the target of a lot of ire and campaign attacks. But weirdly enough, I think a lot of the ire around inflation is aimed at companies. I think there is a strong narrative out there that companies are taking advantage of the situation to like raise prices, claiming supply chain or claiming higher costs. And so it seems like that's where a lot of the attacks have been aimed so far, is predatory organizations, corporations, etc., who are hiking up prices. You saw, I think Wendy's is going to do surge pricing.
That was a public relations
pricing. So I think, oddly enough, this is like the one time where the Fed is not the being seen as a culprit behind the price concerns. It's more companies. In terms of the rates, interest rates themselves, and the impact that's having on the housing market, again, I do feel like the Fed is not necessarily getting the same level of political blowback it would have otherwise, because, well, two things. In 2021, a lot of people bought a home. So those who could are happy. No one's worried about high interest rates because they already have their house. Those who can't afford it, meaning mostly younger folks or lower income folks, don't have the same political voice that millennials and those older and wealthier do. It sounds very callous to say it, frame it that way, but that's the reality of it. It's that
true, yeah. Been true for 100 years.
Yeah, exactly. And so I think that's why I don't see the Fed as much of a campaign issue as it would have been in the previous era.
Gotcha. And the upcoming Fed meeting is March 20. The decision's on March 20th. If you were in the audience, what are some questions that you would try to nail Fed Chair Powell with if you were trying to play stump the Fed chair?
Oh, that's a good one. I think it goes back to what we started this conversation with, and what Brendan alluded to with his question about the BLS potential revisions to the housing component of the CPI. It's just,
yeah. And even beyond that, we get just the annual CPI revisions, which could be large. Yeah.
There was a time, if you remember this, when the Fed said, "Oh, we're not just looking," because it was during like the pandemic influence period, where they said, "We're not looking at just government data. We're also going to use alternative data.
Yeah.
Build out a fuller picture of what's happening in the economy." And then it seemed like, I forget if it might have come up again, and he was like, "Oh, well, now we're going back to more just like the conventional approach, when we're less reliant on the alternative stuff." My question would be, given what everyone knows to be the inherent flaws in both the CPI, PCE, and BLS jobs report data, should the Fed rely on them as much for its monetary policy, as opposed to using more real-time, faster alternative sources of both numerical and qualitative data to inform its monetary policy decisions? I frankly just believe that using CPI, PCE, and the jobs report is just a fool's errand. That's my personal opinion. I don't think they give you enough information to confidently dictate or determine monetary policy.
And the data we got yesterday, February 29th, was for January. Today is March, so it's incredibly backward looking. Yeah.
I can't believe it's March already. My gosh.
I know. It's just like.
Brai, it's always great pleasure to have you on. Insightful and clear thinking. It's terrific. And so now I'll let you guys close by fighting about soccer.
Well, my team is not doing very well right now, so I don't really have a leg to stand on.
Football kids stole a cup from you. You could have saved the season with the Carabao, but
yeah. Well, I will say this actually. Thank you, John. I appreciate this. I appreciate the opportunity to make it. So, as Warren Buffett says all the time, like you have to invest in the long term. It's not about short term. You have to like put your money in with the long term view. I like to believe that all the kids that the Chelsea owners have expensively accumulated over the past season or two will, in the long term, pay dividends for the fans. That's my hope and belief.
Excellent.
I'll end on Wendy's actually missed a great opportunity. When I saw the headline, I thought it was genius, but they only took it halfway. They were they were only raising prices. There's a bar in Barcelona that has a stock ticker, and depending on supply and demand, like the prices of tequila shots can be like 25 cents, and then you want to buy it. So if Wendy's had done full market pricing, where I can get a chili for 50 cents, I would have been all in on that, and people would have gone. But if you're only going to charge more, then everyone's going to get really mad.
From a communications point of view, that was a massive own goal. The headline that says surge pricing, no one surge pricing.
Everybody hates surge pricing. Yes, it's
especially now when everyone's mad about higher prices. You're gonna lead with higher prices.
Yeah, come on, Wendy's. All right. Well, that's our show. Next week we've got jobs. It's jobs, February jobs, the big
Yeah.
big deal, despite the fact that Brai pours cold water on the on the significance of it. It's still gonna be a big drum roll. So thanks again to Brai Valerio-Esene from SW4 Insights for joining us on our inaugural episode of the Markets Policy Macrocast, our new format, our new era. And thanks everybody for listening.
Thank you. Thanks for having me.